Welcome to our deep dive into the intriguing world of high-yield bonds. Often hailed as the treasure trove for the daring investor, these financial instruments hide more than meets the eye. Today, we uncover the veiled risks and reveal why these tempting offers might not always be what they seem. Are you ready to explore the darker side of high-yield bonds? Stay tuned. Default risk. Let's start with the elephant in the room, default risk. High-yield bonds, often labeled as junk bonds, dance on a tightrope of financial stability. They hold a notorious reputation for higher default risks. What does this mean for you as an investor? Simply put, there's a considerably higher chance that the issuer might buckle under financial pressure, failing to cough up interest payments or even the principal amount. It's a game of high stakes, where the promise of hefty returns comes with the peril of potential defaults. Consider this: when you invest in high-yield bonds, you're essentially placing a bet on the issuer's financial health. Unlike stable, investment-grade bonds, these risky ventures are often the last in line to receive payment in case of bankruptcy. This risk is not just a mere possibility. History is littered with examples where high-yield bond investors faced significant losses. It's a financial landscape where the promise of high returns is entwined with the peril of losing your principal, a scenario that demands cautious consideration and a risk appetite. Credit quality and speculative nature. Next up, let's delve into the realm of credit quality and speculative nature. Issued primarily by companies with lower credit ratings, high-yield bonds are the mavericks of the bond world. Their speculative nature demands that investors be compensated with higher yields, a lure for those willing to gamble on the underdogs of the corporate world. But remember, high returns often walk hand in hand with high risks. Are you willing to bet on the uncertainty? The allure of high-yield bonds often lies in their rebel status, operating outside the norms of traditional, low-risk investments. But with this rebellion comes a warning: the speculative nature of these bonds is akin to walking on financial thin ice. Investors are attracted to the potential for higher income, yet they must be prepared for the possibility of a credit event that could diminish the bond's value. It's a high-wire act, balancing the temptation of high returns against the reality of potentially shaky credit foundations. Interest rate sensitivity. Interest rate sensitivity is another crucial aspect of high-yield bonds. These bonds have a chameleon-like quality, reacting sensitively to the ebb and flow of interest rates. When rates climb, the value of existing bonds can take a plunge, potentially leading to capital losses for investors. It's a precarious balancing act, where rising interest rates can erode the value of your high-yield investments. In the complex dance of interest rates and bond prices, high-yield bonds often move to a different rhythm. Their sensitivity to interest rate changes can lead to heightened volatility. As rates rise, bond prices typically fall, and vice versa. For high-yield bonds, this effect can be magnified, making timing and market foresight crucial. Investors need to stay vigilant, keeping an eye on the broader economic trends and the Federal Reserve's interest rate decisions, which can dramatically influence their bond investments' performance. Market liquidity concerns. Market liquidity concerns are often overlooked but are a vital piece of the puzzle. Unlike their investment-grade counterparts, the market for high-yield bonds can be as unpredictable as a desert river, flowing in abundance one moment and dry the next. In turbulent times, this market can constrict, leaving investors stranded and unable to buy or sell at favorable prices. It's a market where timing is everything, yet predictability is scarce. Imagine trying to sell a high-yield bond in a panicked market. It's akin to finding a buyer for a luxury yacht during a storm. In turbulent times, the already thin market for these bonds can evaporate, leaving sellers facing significant price drops to entice buyers. This illiquidity can be a double-edged sword. It can offer buying opportunities when the market is down, but it can also trap investors in a position they cannot easily exit without incurring losses. This aspect of high-yield bonds demands a strategic approach to buying and selling, often necessitating a longer-term investment horizon. Cyclical sensitivity. Diving deeper, let's discuss cyclical sensitivity. Many high-yield bonds are born from companies in cyclical industries or those with fluctuating earnings. This cyclical nature means your investment is tethered to the unpredictable roller coaster of economic cycles, vulnerable to industry-specific downturns. For investors, this translates to a ride that's exhilarating during economic highs, but stomach-churning during the lows. High-yield bonds are not just sensitive to the overall economy, they're often at the mercy of specific industry cycles. For instance, bonds from the energy sector might be highly lucrative during a boom but can plummet in value during an oil price crash. This sector-specific risk requires investors to have a keen understanding of the industries they're investing in. It calls for diversification, not just across different bonds, but across various sectors, diluting the impact of any single industry downturn on your overall portfolio. Amplified impact of economic downturns. Lastly, we must consider the amplified impact of economic downturns. In times of financial turmoil, the fault lines in high-yield bonds become glaringly apparent. Default rates can skyrocket, leaving investors facing substantial losses, especially if their portfolio is heavily skewed towards these risky assets. It's a stark reminder that what glitters in good times can quickly tarnish in bad. The real test of high-yield bonds comes during economic downturns. As companies struggle to keep afloat, those with weaker financials, typically the issuers of high-yield bonds, are more likely to default. In such scenarios, these bonds can experience dramatic drops in value, erasing significant portions of invested capital. The 2008 financial crisis, for instance, saw high-yield bond markets crash, a harsh lesson for investors who had underestimated the impact of a severe economic downturn. This scenario underscores the importance of a well-thought-out investment strategy that considers the potential for extreme market conditions. As we wrap up our journey through the shadowed paths of high-yield bonds, it's clear that these instruments are not for the faint of heart. They offer a seductive blend of high returns and high risks, a siren call for the bold investor. But as with any siren, the allure comes with a warning. Are you prepared to navigate these turbulent waters, or is it a risk too great to take? Join us next time as we unravel more mysteries of the financial world. Don't forget to like, share, and subscribe for more insightful content. Until then, invest wisely and stay informed.